Hey, Ken Smith back talking to you about the world of finance, savings, retirement, insurance. Today we're going to talk about understanding premium finance life insurance. Now this is to some degree a continuation of our prior video where we talked about how small employers save for retirement. We looked at a bunch of different qualified retirement plan options. If you're interested in potential small business, if you're a small business owner and looking at qualified retirement plan options, please check out that video. But it is not a prerequisite to watch this video. This video will make perfect sense to you if you found this video simply by trying to understand premium finance life insurance. Premium finance life insurance is what I often consider oversold, meaning that it's over-explained and made out to be much more complicated than it really is. It's a very, very simple concept. It's been used in the real estate world for years and years. It's just been applied to the life insurance world for the last few years. So if you're interested in premium finance and you have a need for life insurance, the reasons you might consider premium finance is, first off, you have a need for life insurance and you don't want to sell other assets that might trip capital gains or other tax. You don't want to create a tax consequence by selling something to have the cash to buy the life insurance. You might also look at premium finance life insurance if you have gifting issues, if you're trying to fund a life insurance policy for an estate tax purposes and it's going to be a premium larger than what you have the ability to gift without filing gift tax returns. Also, if you are comfortable using leverage and have assets that are sort of dormant or non-performing, so just money sitting in a brokerage account that can be assigned somewhere, that might be a situation where you can kind of double dip. You can use that money, you can leverage that money. And usually the people who do that are looking to create substantial additional long-term wealth. And this is one of the ways you can do that by using premium finance life insurance. So let's look at how it works. Now for our purposes today, we're going to use an index universal life insurance policy as our funding option. That is not necessarily always the case. You can use traditional universal life insurance. You can use whole life insurance. There's lots of different types of products. You can use guaranteed universal life insurance. We're going to use index today only because I had to pick one as an example. And the way index universal life insurance works is this. You greatly overfund the premium required for the life insurance. You actually fund it all the way up to the maximum the IRS will allow you, called the 7702 limits. And that additional premium, you have expenses that come out of it. You have state and federal premium tax from every payment that gets made in the policy. You have commissions paid to the agent, and everything above that is then invested in some form of an index. Now, many of our clients like this because they're index investors to start with, so you're usually investing it in the S&P 500 index. The return will have a cap and it'll have a floor. So it has a maximum you can get and it has a safety net under it. This is kind of what that looks like. So I just picked a number out of the air. Let's say the cap is 9% and the S&P 500 index is the index you're investing in. If the S&P is up 6.5%, your policy is credited 6.5% on that excess premium. If the index is above 9%, so if the index returns 27%, you get 9%. So you're capped in what your return can be. Now, there's also something called a hurdle rate. And a hurdle rate might be 4%. They're usually in the 2 to 5% range. And a hurdle rate says this: whatever the S&P's return is, you subtract the hurdle rate from it, and that's your return. So in my example here, I said assume the S&P's up 28% for the 1 year period you're looking at. And by the way, you can usually invest it over 1, 2, or 5 year tranches or buckets in the S&P. But if the S&P was up 28% over that 1 year period, you subtract the 4% hurdle rate, and your actual return is 24%. So since the upside is capped and/or there's a hurdle, there's got to be a benefit to that, and the benefit to that is the floor. This is the sizzle in an index policy, and the floor simply says we don't care how bad the market gets. Your worst case scenario return is 0 or 1%. Most policies at 0%. And you might be sitting there thinking, I want the 1%. Well, guess what? There's a price to pay for the 1% on the other side of it. So what you get net effect is a smoothing out of returns. You don't have huge up years and you don't have huge down years. And anybody that's ever invested in the stock market knows if you're down 50% this year, so you had $100 and you lose 50% of it, you're down to $50. and you're up 50% next year, the average annual return might be zero, but you got 75 bucks at the end of year two. You are nowhere near back to even. So you got to remember the floor is really what makes a difference, and it also takes market timing out of the equation. You get a bunch of money available to invest, you no longer have to worry about, am I investing at the top of the market? Because worst case scenario, 1 year from now, you're at zero. Now, I mentioned at the onset of this video, this is sort of a continuation of a prior video. You don't have to go back and watch that video if you don't want to. But in that case, we had a small employer. He had about 20 employees, and he was comfortable putting about $51,000, and the actual number was $51,200, into a qualified retirement plan for he and his employees. But what we discovered was if he did that, he only got about $25,000, $26,000 in his retirement pocket himself. So this was our look at an alternative for him. And the first place we looked was an index universal life insurance policy. We could fund it at $51,000 a year for 21 years. At the end of that period, he could pull out about $180,000 a year for the rest of his life, actually through age 100, in tax-free retirement income. And that was, by the way, more than double what he could have pulled out of a qualified retirement plan, which also would have been taxable. He loved it. It made much more sense than the qualified retirement plan. However, this particular individual was comfortable with leverage. He borrowed money regularly in his business and he understood collateral. So we took it the next step and showed him what a premium finance contract would look like. By the way, so that was a $1.7 million flow over 21 years into the policy. And a $6.4 million flow out over the next 36 years in the policy. And throughout that period, if he were to ever die, there was at least $1.2 million going tax-free to his heirs. So he was going to get something in excess of $7.5 million out of the policy if he lived all the way to age 100. A little bit less if he died at a younger age, which is most likely, but still much, much better than anything we were looking at in a qualified retirement plan. And by the way, the one risk factor in an index universal life insurance policy is this. This is just a screenshot of one of the policies we use of the average returns from the 7 different index options available to them. And what you see here is they run scenarios over lots and lots of time period for each one of these different options, and they give us the worst potential average return and the best potential average return. So you see for the 1-year S&P 500 index, the minimum rate they saw over those periods of time was 3.7. The highest was 7.2. The average was 5.67. That's the number we used in the scenarios we ran for him on the first go-round. You can also see out there to the right, there are much bigger returns available to you if you are a patient investor and willing to either look at one of the other options at the 1 year or look at the 2 or the 5-year options for investing. Also, I mentioned earlier, this is not something the life insurance world invented, right? The real estate folks have been doing this for years and years. This is just a screenshot of a typical real estate transaction. And what you see sitting dead in the middle of that page, what makes this work is loan package, right? They borrow other people's money, they invest it in a property, and they believe that the cost of borrowing the money is lower than what they can earn on that investment. We do the exact same thing with a life insurance policy. So this is just taking the last example and expanding it to make it a life insurance premium finance option. So what you see here is the money actually flowing into the policy flows in over 7 years. It flows in at $225,000 per year. And you see we have a borrowed fund loan balance. So we're always got a loan balance sitting out there until we wipe it out somewhere out in the future, and we'll show you how you're going to do that. But in this case, the client's out-of-pocket is exactly the same. $51,200 per year for 21 years. So let's figure out how we go from $51,000 a year to $225,000 and where that loan balance comes from. So that $51,200, all we're doing with that money is offsetting the annual loan and paying the annual loan interest due on the bank loan or other financing institution. Now, if you've been presented or if you are presented a premium finance ledger, it's going to look like this. A whole bunch of numbers. It doesn't have to be this complicated. Let's just break it down first year, okay? So in the first year, the bank lends you $225,000. You go to the bank and you say, we're going to fund this policy. And by the way, there are lots of financial institutions that are very comfortable doing this. The big banks, the JP Morgans of the world, your community bank locally, they've all seen this. They're very likely extremely comfortable with this. And then there are institutions that do this specifically. They are basically banks set up to do premium financing. So you have a $225,000 per year loan set up for 7 years. And not getting into the weeds, some of them might be set up for 3 years, some set up for 5 years, but the plan is to borrow money for 7 years to finance this policy. So immediately that $225,000 flows into the policy, and that's the first year's funding. That creates loan interest in year one at 2.85%. So by the way, the interest set up on these loans is typically a function of LIBOR, and just like any other loan, the better your credit rating, which most people who do this have perfect or very close to perfect credit ratings, but the better your credit rating, the better your return is, the better your borrowing rate is. In this case, we use LIBOR at this time plus 200 basis points, 2%, got us at about 2.85%. That created that first year interest due of $6,413. Now remember, we deposited $51,200 into the strategy, so we pay the interest off right off the bat. That leaves us with $44,787. And you can see, you can track this across that top line as well. That $44,787 now is used, the additional money, to pay off a portion of the loan. So the $225,000, we pay $44,787 to pay the loan down. And you see now we have $180,000 back up at the top, third column from the left, $180,213 loan balance going into year two. Now, we have to post collateral of some kind. Well, we already have collateral in the policy over on the far right-hand corner. We have a roughly $49,600 cash value sitting in the policy, a surrender value. So we would assign that to the bank. So now we only have to post collateral of $130,000. This is your only additional cost to do this, is posting the collateral. By the way, I mentioned earlier dormant assets to use for the collateral. One of the most popular, most common is other old life insurance policies. You've got old cash value life insurance policies sitting around. They're going to earn what they earn, and you're really not even having any issues of creating additional collateral on the side. Okay, that's the first year. Now let's take a little deeper look at the first 8 years. And you see on the far left-hand side, we've been setting aside $51,200 per year for the strategy. We've completely funded the policy in the first 7 years. We have a roughly $1.376 million loan outstanding. You'll see in this scenario, we started creeping the interest rate up a little bit because we didn't feel like we would always have this low of a borrowing cost. So you see we amp that, or we increase that interest rate up until we get to 3.13% when we're ready to pay the loan off. We've been paying the interest off every year, the loan interest due, and you see we have a little bit left over. It's a dwindling amount each year to pay the loan down because the loan interest is getting bigger every year. But what you see here, if you match column, the far right-hand column, the surrender value column, to the actual loan amount column, you see once the surrender amount is larger than the loan amount, we no longer have to post collateral. So the collateral requirements go away, and we have cash value greater than our loan balance. The next step is exiting the loan. You want to get rid of that loan under most scenarios. Now, under some estate planning scenarios, the loan stays in place until death, especially on older clients. But if you're using this to accumulate cash, you want to get rid of that loan. Now, some clients will do that on occasion out of pocket. There are reasons they do that, right? They sold a business, they've got other cash laying around, they want this policy free and clear, so they'll do that. But most of the time, you just borrow the money back out of the policy to pay the loan off. And you borrow it out, it doesn't cost you anything because once you're on many policies, I should be careful there, on many policies, once you're past the 10-year, there is no borrowing cost. So the loan interest rate charged and the amount credited on the money set aside in the loan account is the same. So it's a no-cost loan to you. That's typically how our policy owners pay off those loans, and I'll model for you now how we would do that. So in this case, we get out to age 64, And you see the loan has actually gone down a little bit. Remember we had, when we stopped making premium payments, $1.376 million loan. Well, we've continued to use that $51,000 a year to pay the annual interest due and also pay a little bit off to get the loan paid down. So we now have a loan outstanding of $1.244 million. And you see there at age 64, we stripped the money out of the policy. You can see on the far right-hand column, our surrender value and our death benefit drop because we're paying off that loan. We're getting the bank completely out of this transaction. And now what we see is, by the only cost being tying up some collateral for this loan, we have gone from $180,000 per year in tax-free retirement income to over $300,000. In fact, in this scenario, $317,000 per year in retirement income. Now, just like the index option we talked about earlier, there are risk factors. There, number one is the same risk factor, right? You've got to have, if the return is lower than what we've projected, you've got some ramifications. And then our other risk factor is the cost of borrowing. If our cost of borrowing goes up, it also has impact on a couple of different factors inside this strategy. Because in fact, just like the real estate transaction we referred to earlier, what makes this work is earning more on the investment than your cost to borrow the money. So in this case, if we can borrow money at 2.85% and earn 5.67%, it's going to give us a very positive outcome. And the greater the spread between those, the better the outcome. So again, there's two risk factors: the return risk from the underlying index investments and the interest rate risk from the cost to borrow. So let's look at how those might impact us. First, let's make the assumption that we get 10% less return. So remember, we modeled it at about a 5.7% return. So let's look at it and assume we got about a 5.1% return. And what you see here is we have a very slightly longer collateral requirement because our cash values are lower. And remember, our collateral requirement sits there until our cash value exceeds our loan balance. So we have 2 additional years of collateral requirements. They're not big, but we have additional collateral requirements. And likewise, when we get to retirement, again, assuming that 10% was every single year, we had 10% less return than we modeled every single year, our actual retirement income would go from the 317 we looked at earlier to about 285. Likewise, our cash value throughout, which makes sense, but also our death benefit would go down again by about 10%. So still much better than the 180,000 we had prior to looking at the premium finance option, but lower than under a perfect scenario, which actually I wouldn't even classify the first scenario as a perfect scenario. Hopefully we will get better returns than what we've modeled here, but you never know. So the second thing we want to look at is what if our cost of borrowing went up? Now this was one that this particular client said, I want to look at this scenario. So he said, increase my cost of borrowing by 20 basis points, 0.2%, year over year. It seemed extreme to us, but he asked, so we complied. Until basically I've doubled my cost of borrowing. So we go from a 2.85 to a 5.65%. Not quite double, but very, very close to doubling. And you see, again, it doesn't blow the strategy up. It just causes us to have a very slightly larger collateral requirement. Interestingly, it's no more years. It's the same 5-year requirement, but because our loan cost is slightly higher, we don't have quite as much money left over to pay the loan balance down year over year. So what you see is our collateral requirements change just very, very slightly. The larger impact we see by increasing the cost of borrowing is the fact that we have a larger loan balance to pay off. We now have a $1.8 million loan balance to pay off. Now, the results of that are obvious. We have less cash value for retirement. Therefore, our retirement income is driven down, in this case to about $240,000. And we also have a slightly smaller death benefit for the remainder of the policy's life. However, what we find is we run a great many different scenarios for clients, varying the return, varying the interest rate. What we have discovered is under pretty much any one of those scenarios, the vast majority of the time, if the client is comfortable borrowing money for the strategy, if they're comfortable with the concept of leverage and of posting collateral for a few years, the strategy always is to their benefit. We have better outcomes using the strategy than not using the strategy. And we should note here, the client has the same out-of-pocket cost in this strategy, $51,200. That's what they committed, that's what they wanted to put into the strategy. So no matter whether we have a higher cost to borrow, a lower return, or both, the impact is on the retirement income, not on the out-of-pocket. There can be an impact as well, as we've seen on collateral requirements, but generally the impact is just on the amount of money coming out in retirement. So again, in summary, looking at our risk for the premium finance strategy, we have return risk, could cause longer and larger collateral requirements, and we could have lower cash value resulting in smaller retirement income and smaller death benefit to our heirs. Our interest rate risk, we could have probably not, but potentially longer collateral requirements. It could happen if they got very, very expensive, and slightly larger collateral requirements as well. We would also, if we had a much higher cost to borrow, we would have a higher loan amount to be paid off when we wanted to exit the strategy, therefore giving us lower retirement income and less death benefit left over to our heirs. Under either of those scenarios, though, in this case, the client was comfortable that we were going to get a better return than he would have not using a finance strategy. So this particular client chose to use the finance strategy. Now, there are a couple of red flags if you're being pitched premium finance. And I'm not going to throw anybody under the bus, but things to be watchful for. Okay, so if somebody is approaching you or talking to you about premium finance, there's a couple of red flags, a couple things to be aware of. The first one is, and I use the term promoter, firms, companies, talking to you about free insurance. And by free insurance, what I mean is this. They will tell you that there's going to be a bank loan established to fund the life insurance policy, and there's going to be a second loan established that will be paying off the interest on the policy every year. So all you really are, and if they're non-recourse, they'll tell you, don't worry, there's no real downside to this, and there is. So first off, if the life insurance company, and by the way, what they'll normally do is ask you to pay a loan origination fee. They'll say, if you're only out of pocket is this loan origination fee, and they're usually pretty substantial. They use this strategy, or they try to use this strategy a lot to build non-qualified retirement plans for key corporate employees. First off, if a life insurance company is aware that there's a second loan, that somebody is financing the interest on the policy, they are not interested in this. They will not tell the company that that's the case. They will, if you ask them that directly, they will dance around that every way possible, and they'll tell you the company will never find out about this. Well, our belief is if that company does find out about that and that policy is rescinded, then you're going to be left without your money you put up front for the loan origination fee, with no policy as well. So the second red flag is because of the first red flag. They will ask you to sign a non-disclosure agreement to see the strategy. They do that for several reasons. Number one, they don't want the carrier finding out what they're doing. Number two, they really don't want your CPA or your attorney looking at this strategy. And if they do look at this strategy, they don't want your CPA or your attorney, they're also going to sign a non-disclosure agreement, being able to talk to someone who understands this strategy to really see where the flaws are and where the tax traps are inside this strategy, because there is a big tax trap inside the strategy as well. There are no secrets in the premium finance world. There are just strategies that promoters don't want to be scrutinized by your advisor team, by your legal team, and by your accounting team. The tax trap is this. So what they will tell you is, if you go through this strategy and you decide at some point you don't want this strategy anymore, you simply give the policy back. And actually, if you're ever able to look at their loan documents, my understanding is that if you default on the loan, they actually have the ability to recall that policy and take ownership of that policy. They create an LLC, a limited liability corporation, to own the policy, so that the carrier is never aware that somebody else owns that policy. They make the ownership change at the LLC level, and they do that because the carriers don't want something known as stranger-owned life insurance. Again, they're hiding stuff inside this non-disclosure agreement. Just know this. If this strategy doesn't work, and by the way, they're very aggressive in how they model the strategy. If this strategy doesn't work and you want out of the strategy, then the out is you simply give them the policy back. And that's what they say. Look, it's a non-recourse loan. We can't come back on you on that. All we'll do is take the policy back. Well, Couple problems with that. Number one, you've got a bigger origination fee you've already spent, but more importantly, you just gave a policy, if you will, to an institution for forgiveness of a loan. The IRS is going to look at that and go, that sure looks like there was something giving for value, right? You gave a policy back to get a loan forgiven. And it's going to look like a taxable transaction to them. Again, I am not a CPA, I am not an attorney, but my understanding is the debt above the cost basis forgiven would be considered capital gains, and the cash value above the cost basis would likely be considered ordinary income. So you could potentially have a pretty big tax burden sitting out there at the end of this period when you have no policy, you're out your origination fee, and you owe Uncle Sam some money as well. So just be aware this is not something that's talked about. It's part of the reason we believe they don't want advisors looking at this, why there's non-disclosure agreements. They don't want your CPA looking at the tax ramifications, and they don't want the attorney looking at how you would simply give the policy back and what that might trigger, which most attorneys would catch this as well. So just be aware that's a problem inside that strategy, and it's a big one. So let's look at the finance versus the non-finance strategy side by side. So again, $51,200 out of pocket over both of these for 21 years, from age 44 to age 65. The finance contract, the additional requirements are you got to get a loan, and therefore you have collateral required of you for, in this scenario, 5 years. It could be longer, it could be shorter, according to how much you want to be out of pocket. Obviously, that number could be an even number. This individual could have done $30,000 a year or $100,000 a year. It's just going to change how much the loan's being paid off and what the loan amount is at the end of the period of time. Now, this particular individual's life expectancy was about 85 years old. He was a healthy 44-year-old. So he would have funded $51,200 per year for 21 years, just a little bit over $1 million. At the end of that period, at death, if you will, at 85, he would have pulled $317,000 a year out for 20 years. That is $6.3 million. And then there would be another $2.9 million available to him in death benefit, actually not available to him, available to his heirs in death benefit. So he puts $1 million in, he pulls $9.2 million. He and his family pull $9.2 million out. That is a 9.8% tax-free rate of return, all tax-free. Retirement income tax-free if structured properly. Death benefit tax-free, again, if structured properly. If you compare that to a taxable rate of return, you'd have to have in excess of a 14% taxable rate of return on your $51,000 per year to match that rate of return. It is for those who qualify, by the way, I didn't mention this early on, you pretty much have to be accredited investor. You have to have some assets. You have to be comfortable with investing and with borrowing. But if you meet those criteria, this can be quite an amazing strategy from a rate of return on the cash value and the death benefit, and or just the death benefit if you're doing it for an estate tax or some other long-term need for life insurance strategy. If you want to learn more about this, if you want to see this modeled for yourself, you can reach me at Ken Smith Advisor, not plural, Ken Smith ADVISOR at iCloud.com, or my direct dial phone number 972-816-5367. Our next video, we're going to tackle long-term care insurance. So stick around for that. I've got other videos posted. If you've not seen them, you can see the playlist available on my website, on my YouTube channel. And I hope you enjoy these videos, and I'm looking forward to hearing from you. Thanks.